Hi, I'm Sarah Benwell, the editor of InsuranceInvestor.com, and I'm here with Marcello Estevao, Global Director, Macroeconomics, Trade and Investment at the World Bank Group. Marcello is speaking at our Insurance Investor Live conference later this year, and ahead of that, we just wanted to catch up with him to get a little bit of a flavor of what he's going to be talking about. Hi, Marcello, thank you for joining me.
Hi, Sarah. It's a great pleasure to be here with you.
So I'm going to start with a huge question, for which I apologize, but what are some of the biggest macroeconomic trends affecting investors at the moment?
I mean, the key issue of the moment is the link, the nexus between the inflationary shocks and the evolution of global economic activity. And of course, the globe is made of countries. So the story is very varied depending on which country you're focusing on. So the issue of how persistent these inflationary shocks are is quite current. The question matters tremendously if you're following the U.S. economy. So we are sitting here, is mid-June. We just got news last week of stronger than expected inflation figures. The Fed reacted to it and just raised the Fed funds rate by 75 basis points when, like just a week ago, the market was pricing a 50 basis points increase. So I think this interaction between monetary policy actions, given what's happening on the inflation side, are going to be very live for many months. You see that in Europe as well. In Europe, of course, the issue is different because the European, let's talk about the Eurozone. The countries have different cycles, different fiscal authorities. So it's not like the US when the Fed says, Fed funds rates are going to raise by 75 basis points, interest rates raised by the same amount if you are in southern Texas or if you are in Maine. Now, in Europe, that's not the case. In Europe, when the ECB tries to do something like that, you have spreads for Italian bonds behave in a very different way than spreads for German bonds. So for Europe, there is this additional wrinkle, which is a big wrinkle, that they have to deal with. But there's not much doubt that the ECB will be raising rates as well. And you've seen the Bank of England doing the same. Everywhere, central banks are raising rates, with the exception of some key countries like Japan, which has its own issues. But anyway, I think this connection between inflationary shocks and what central banks are going to do, what will be the impact on the real economy matters. So there's a whole discussion of possible very low growth for a long time with high inflation, which is a bit reminiscent of the 1970s. So some people are worried about that. And for investors, that matters very much. Now, related to this is the fact that, and then I'll talk about briefly here about what keeps me awake at night, is the fact that this recovery that we've had till, say, the invasion of the Ukraine several months ago, has been quite unequal, with developed economies doing quite well, but emerging markets and developing economies not doing so well, in particular the poorer ones in this income distribution around the world. And for investors that have kind of begin to invest in those economies, the so-called frontier economies, the issue of how are they going to do as the central banks in the core of the world economy raise rates is also a big deal. And how fast will be this convergence of economic activity, the levels of economic well-being in emerging markets and developed economies toward the levels of well-being in advanced economies matters, in particular if you are buy and hold type of investor that is trying to get real returns and often takes some risks because you have a vision on the long term. So all this is, Sarah, is kind of affecting, all these effects are kind of interacting in different ways. Happy to talk more about that. And I'm sure whenever we have the event, I think it's in November, just like almost 6 months from now, the world may be in a quite different place.
No, absolutely. And I'm expecting to hear more from you then about kind of how things have changed since now, because I imagine it will be, as you say, quite different. But thinking about the trends you've kind of identified so far, how do you see inflation, et cetera? How do you see those impacting investors' decisions on how to allocate their assets? Like what's the kind of nitty gritty impact for the investors themselves?
Well, investors are finding ways. There are many different types of investors around, and many investors, in particular, I think some of the ones that focus on insurance are looking at hedges to inflation risks. So there is a movement toward buying inflation-indexed bonds, toward buying hedges against inflation like real assets. So you've seen some of that also, including real estate prices going up. And with the Fed action in the US, you are going to see, we already seen in the data, a lot of that demand for real estate coming down. But you do see bigger investors buying real assets and trying to shore up that uncertainty by doing so. So that's one aspect that I see investors doing. And in particular, if you're talking about investors that are going to buy and hold for a long time, understanding these discrepancies across different markets, where is the best place to park your money is quite important. I do think sometimes the industry is not so good at looking at things a big picture. I mean, I'm in a privileged position because of the position I have now, and because of my professional history of having worked in many places, from the Federal Reserve to the IMF to the private sector. I was chief economist in a hedge fund, and having been doing policy in emerging markets as deputy minister in my time in Brazil, and now at the World Bank. So I had this, it's a bit of a privilege to have looked at all these different types of angles when crises like that hit. And I think the investors would benefit from trying to broaden that view and really look, for instance, if you are interested in this country, that the situation is not so dire, that may be surviving better these strains, these shocks, that is the country for you to invest. Of course, I cannot say out loud what are my what countries I think are in better shape to brave the storm, in particular because things may change by the end of the year. But I think that's what investors should be looking at. There'll be, volatility is really a great thing, in particular if you invest on macro variable. But I think if you're also a long-term investor and trying to hedge against shocks, volatility can also help if you make the right decision. So here the message is be informed, think big picture. There are many countries around the world that are not in the usual beaten path. And that's where I think the key to a successful investment strategy will be.
Lovely. And then last one from me, I did very unfair of me, but I'm going to kind of ask you to get your crystal ball out a little bit. You've talked about some of the current trends affecting investors. What do you think are some of the big macro or geopolitical issues that are emerging either in the near or in the longer term future?
I think this issue of divergence is a quite important issue. And with some economies doing much better than others, even though everybody's facing a common shock, which is this common shock in commodity prices, this common shock in particular, energy prices, but also food prices, depending which country you're talking about. So that trend of divergence should continue going forward. We've seen before the invasion of the Ukraine. I think the invasion of the Ukraine has exacerbated some of this differentiation. So countries that are large net exporters of energy goods are doing better. So, for instance, risks in the Middle East, economic risks in the Middle East have come down because of oil prices have gone up. Of course, I'm talking about the Middle East countries that export energy. Some do not actually, something that often people do not realize. But in general, for the region, the risks have come down. For other regions, the risk have gone up. So I think the regions that are going to do the best in the next year or so are the ones that happen to be exporter of energy goods and of food goods. And there are a couple of countries like that, not many, but there are a couple of countries like that. So those countries may be able to withstand the shocks better. The ones that are very close to the cycles of developed economies, the monetary cycles of developed economies, are going to be facing more of a challenge in terms of pressures for capital to flow out of their country. We already see that. But surprisingly, in some regions, not much capital outflow has happened. And here I'm thinking about Latin America, actually, not as much. And maybe not as surprising as the large economies in the region have raised interest rates already. So they have been quite active, in part because they've seen inflation happening in the economies early on. So that may have shored up some of these economies. They also tend to be a mix of energy exporters and food exporters, a few of them, maybe one or two, being both net exporters. Regions like the Caribbean will be having a hard time because they tend, with the exception of Trinidad and Tobago, that tends to be more of net importers of both food and energy goods, and also they have been hit by what's happening with the tourism industry. We haven't talked about tourism. A lot of this, what happens still with COVID this year, is going to be determined the direction for some of these regions, and I think investors should keep an eye on that type of information as well.
Lovely, thank you. This has been really interesting, and obviously, who knows where we'll be by November. But I can't wait to hear an update from you and get a bit more kind of an economic what's going on then and what investors can do about it. Thank you so much for talking to me.
Great, Sarah. It has been a pleasure, and this is a big topic. We took some bites out of it, but hopefully it has been a bit useful, and we can talk more later. Thanks so much.
Thank you.